Thank you, friends. I must first say thanks to Kotak Alternates, who's organized today's program. And I hope many of you think you're getting some gyan. I want to start by first today's subject on a very interesting aspect of history, because this group is responsible for making investments which are normally a little longer term, less liquid, and supposed to produce higher returns. But keep in mind, higher returns come with higher risks. So I want everyone in this room to be first aware of this fact, that it always looks good when you look at from the return side. And the key thing in investing is the returns you produce, which should be disproportionate for the risks you take. That means your returns must be superior to the risks you have taken. And that is the real game of investing. And I'll move to the macro, which is on top of everyone's mind today. And it takes me to the world of finance and investing into two parts. Part one, which is last 80 years, 81 now, which is 1945 to 2026. And part two is 1930 and before, or 1929 and before. And then there is that interim period, which is the 16 years from 1929 to 1945. So the world of investing for the last 81 years has gone through what I call as move back to equilibrium, which means from time to time, the world gets shocks. Shocks of the kind that there is an oil shock, there is a Gulf War, there is a AI change, there is a digital world which is coming in. There is perestroika, when you saw the dissolution of the USSR, or Cold War, which happened in the 60s and the 70s, even as up to the 80s. So, or COVID, which we saw very recently. So in the last 80 plus years, every time there has been a shock to the world, it has been an investing opportunity. Of course, you got to time it right, therefore you don't invest it on the first day of the shock, but at some point of time, the last 80 years history has shown what I would call as return back to equilibrium. Bad news, financial markets correct, some of the real markets correct. You bide your time, you choose your assets, you choose your investments, make your investments in that period, and at the end of it, you find return to normal and you made supernormal returns. COVID is the most outstanding example. At the beginning of COVID, when the entire real estate sector looked empty, offices empty, hotels empty, everything empty, people said real estate is in trouble. And then work from home started. Okay, so people said, wow, this is going to change life. In many ways, it changed life. But you see the kind of bounce back which happened in the real estate sector, particularly residential real estate, where people valued the home a lot more. And the kind of returns people made investing in residential real estate post-COVID are phenomenal. So coming back to the core theme, 81 years of the world's history, 1945 to 2026, was time to time you get a crisis. In the crisis period, at some point of time, you make your investments, and then you sit back and have a wonderful return for 2, 3, 4 years, depending on how deep the crisis is. Now I shall talk to you about period prior to 1945 and particularly post 1929. And just to give you a historical perspective, in 1920, some of you may not be aware that there was a Spanish flu, exactly similar to COVID 100 years ago. And the bull markets between 1920 and 1929 are one of the craziest bull markets in the world for that 9-year period. And then in 1929, you saw the biggest crash on Wall Street, followed by the Great Depression across US and Europe, and it engulfed the rest of the world as well. Therefore, the pre-45 period, and again that within that period, pre-1929 and post-1929, you were in a very different world. And I'm not making any comparisons, but exactly 100 years later, in 2020, you had COVID. Therefore, I'm not predicting anything of 2026, 27, 28, 29. Don't mistake me, but I'm just giving you historical facts. This is what happened in 1920. 1920 to 29 was the best period to invest. Keep in mind, it was a 9-year period, but there was no digital then. And it was a much slower world. And we are in a different world today. So I call this period prior to 1945, in my memory, as grandfather days. My grandfather was born in 1906. He was at his youth peak in the period 1929 to 1945. And he therefore saw the full impact of what a Great Depression could do. And as a child, I grew up with him. And he said, बेटा, तुम लोग ने 1930 की मंदी नहीं देखी है. And where the mindset of the human being moved from getting back to equilibrium to that if things are bad today, they will be worse tomorrow. And it did happen. And therefore the concept of saving, frugality, living within your means, high levels of bankruptcy were all the reality the world of 1929 to 1945 faced. But for the next 80 years, if you lived in the first world, this is 1929 to 1945 or 42, 43 when you started seeing the turnaround. If you still lived in the pre-1945 world, you would have missed the biggest bull market and financial investment world in your lives. So, the question in front of us is the world ahead with all the geopolitics? And you all know that it was a Great Depression of 1929, which was the beginning of Hitler's Germany, and then the World War, which happened 8-9 years later. So, which is the world we are in today? Are we in the world which is the continuation of last 80 years? Or are we in the world where there is a small probability that is prior to 1945? And frankly, nobody has an answer. But when you make your investment decisions, friends, even if your base case is what is true for the last 80 years, will be the base case for the future. Price in a small probability adjusted factor, which normally is very dangerous to do, but therefore a low probability that this time may be different. And therefore, in your chase for returns, keep a small pocket for fear of risk. Okay? And maybe Srini and Ishwar and the team at Kamal had the vision and the foresight to organize this meeting today and arranged the geopolitics of the last 10 days to suit the timing of this conference. Correct. But friends, go for greed. Greed is, who was that? Mr. Gecko said, no? Mr. Gecko said greed is good. But do not forget the fear. And do not forget the small probability that if things go wrong, what is your downside protection? For many of you who have witnessed the famous security scandal of 1992, some of you, the younger generation would not have, but some of you would have witnessed the security scandal of 1992. I knew some friends then who put all their money, entire stock market portfolio, into one brilliant stock whose name was Karnataka Ball Bearing. Nobody cared what it made. Nobody cared whether it produced anything. But it was the most sought after stock in the Indian market. And for many of you, immediately Google it and you'll get the full history of Karnataka Ball Bearing, where the stock went up more than 1,000% within 6 months and faster to zero in the next 6 months. Okay? And it was a favorite stock, and most people thought it was a genuine ball bearing company. Okay? And it was being promoted by a famous investor whose fundamental philosophy was grow more. Okay, it was Harshad Mehta's company, which was known as Grow More Leasing, which was the biggest investor in Karnataka Ball Bearing. Therefore, my point to you is, I'm very happy for each of you as you take the path down alternative avenues for investment. But I also would like to caution you. You don't know whether we are on the right side of history or the wrong side of history. And as a betting man, keep a small probability that there is a possibility of wrong side of history. Though fundamentally, I believe that what is true for 80 years may be true again. So this is point number one. Then point number two is on everybody's mind. Where to put money? Very little opportunity. These bankers giving 2.5% on savings deposit. They think we are fools. We're going to put our money in savings deposit. Then there is liquid funds, where you're happy getting 5%. Then there is this wonderful animal which is giving debt returns, lower capital gains tax, but actually is equity arbitrage, called equity arbitrage funds. That is giving 6.5%. Okay? It may reduce a bit from April 1. Some STT, BSTT changes are happening, so keep an eye on that. And then there is public market equities. Then there is startup, where I invest before it lists. And I will get an IPO pop. And then there are IPOs, which hold up the price for the first 120 days. And then when every other investor is allowed to sell, suddenly drop. And then there is a new wonderful animal, which is now called alternate investment funds. It is manna from heaven. It is giving higher returns with not as much risk. Please apply your minds and take your calls judiciously. Always keep in mind risk versus return. Yes, fund managers do matter. A better fund manager will do a better risk-adjusted return analysis for you than not so focused fund manager who can manage risk and return. And since I'm speaking on this platform, I'm saying Kamal so far has done a reasonable job. But you know the mutual fund line, na? Past performance is no guarantee for the future. Okay? But in general, the bank and the group is putting their own money alongside you. Okay? Therefore, we are as concerned about how well they invest as each of you are. And I think for every one of our funds on the alternate side, the group puts in 15% of its capital alongside. And therefore, there is a belief that this can improve returns and proportionately manage the risk better than the proportion. Okay? That is the fundamental argument of alternate asset funds. But do not put your surpluses out of monies you may require over the next 12, 24, 36 months. These monies are put in for a longer period of time. And therefore, you must have that liquidity surplus so that you won't need these monies for a reasonable period of time. So these returns are longer dated and do not expect quick turnarounds. If you are expecting quick turnarounds, you're better in public mutual funds or public equities or public debt or liquids or FDs. Therefore, plan your risk portfolio very carefully and always remember one principle in life, which I was taught again long back. You know, somebody came and told me, equities average return over last 10 years is 15%. And even if you look at last 3 years, the return is 12%. Okay? Then you ask them, what about last 1 year? Oh, it's about 8%. Okay? Therefore, this happens. This is a part of cycle. I think we had a supernormal cycle in the post-COVID era. You're giving back some of it. And Rohit Sharma says, mutual fund sahi hai. So sahi hoga. Okay? But one line always keep in mind. Whether return is 7% or 10% or 12%, if you have 100 rupees, and I'm only looking at a 1 year period, if you have 100 rupees and your return is 7 or 10, at the end of 1 year, you're comparing between 107 and 110. That is known as return on capital. So second one, 110 is better than 107. So for you're tempted to say, listen, I'm going to put where my return on capital is higher, which is 110 better than 107. But the mantra which I have kept in my life is return of capital, which is my 100 back, is more important than return on capital. Therefore, for incremental 3 rupees, which I'm going to get between 7 and 10, how much is the incremental risk I'm taking about on my 100 itself? So ask that question also. Okay? Return of capital back is more important than return on capital. Okay? Always something, and that saved Kotak in many times, but certainly in the late 90s. I mean, many of you may not be aware that in the late 90s, there used to be 4,000 NBFCs. We were not a bank then. We were a non-bank financial company till 2003. Between 1999 and 2005, out of these 4,000 NBFCs, 3,980 NBFCs died. 3,980 out of 4,000. 20 survived. Fortunately, अपना भी उसमें number लग गया. We were amongst the survivors. But it was not just good luck. It was the simple principle, return of capital is more important than return on capital. Okay? Therefore, keep that in mind and therefore plan your portfolio, which is high risk, high return, higher risk, better return, and bring the third factor into your calculation, which is the liquidity of your portfolio. Don't put all your monies into a manner where it is significantly illiquid, and keep some part of your portfolio which is liquid available to you, and it has to be a reasonable multiple of what you require as your normal spends in a year. Keep enough buffer so that you don't have sleepless nights ever with reference to your short-term money. And beyond that, start investing in a graded manner, have a pretty robust way of allocating portfolios, and be greedy, but not too greedy, okay? Very difficult to make a judgment whether does not too greedy happen versus be greedy. But I have found this, it works for me. It has worked over a long period of time. And at the same time, if you want to make serious money, you can't be too diversified, too fragmented, too much all over the place. Therefore, you have to have the balance right between levels of concentration and levels of diversification. And finally, I would just want each of you to keep one other contrarian principle in mind. At the end of it, you'll be terribly confused. What the hell has Uday Kotak said? But I'll give you the contrarian principle in mind, which is also true. Money is made when blood is flowing on the street. Okay? But you got to figure out kitna khun nikla hai. Okay? So it's never easy. But therefore, in the jungle of investing, you have a variety of options. It is like the land of all the animals. Okay? You got to have a well-planned strategy. And I'm not asking you, I'm not doing any marketing for either Kotak Private or Kamal. I'm just telling you all the options available in front of you. But think it through carefully. And I would like to say two things. On my personal side, I still have my money advised by Kotak, though I am no longer whole-time. And number two, at Kotak, we put money where our mouth is. Okay? With that, thank you very much and have a great evening.